Hello everyone and welcome in this class. I am Kat and today I will be sharing with you the comparison of credit card analysis or credit card statement analysis. Either it is a flat rate, interchange plus, or tiered statements. Introduction. So what is the purpose of statement analysis? When a business processes credit card payments, it incurs fees charged by the payment processor. These fees can vary significantly depending on the pricing model the processor uses. For a business owner, understanding the pricing model can make a big difference in operational costs and profit margins. Here's an overview of credit card processing models. There are three main pricing models in the industry. These are the flat rate, interchange plus, and the tiered pricing. Each model has its own structure for calculating fees, and selecting the right one depends on factors like transaction volume, average ticket size, and the type of cards used by customers, for example, debit, rewards, or corporate cards. Next, understanding the key components of credit card processing fees. To fully grasp the differences between these models, it's important to first understand how credit card processing fees are structured. In the interchange fees are set by the card networks like Visa Card, MasterCard, and others, and go to the issuing bank. These fees typically consist of a percentage of the transaction value plus a fixed fee. For instance, a transaction may occur or incur an interchange fee of 1.5% plus $10 cent. Interchange fees vary depending on the type of card, that's the debit, rewards, corporate, and others, and the transaction method if it is in person or online. Number two is the markup fees. Payment processors are their own markup on top of the interchange fees. The markup can either be a fixed percentage or vary depending on the pricing model chosen. And number three is the assessment fees. These are smaller fees imposed by the card networks for using their networks and typically ranges from 0.11% to 0.13% of the transaction amount. Here is the flat rate pricing model. In the flat rate model, the payment processor charges a single consistent fee for all transactions, regardless of the card type used or the method of payment. For example, a flat rate processor may charge 2.9% plus $30 per transaction for both debit and credit card transactions. Here's the features of flat rate statements. Number one is the simplicity. All transactions are charged the same rate, which is straightforward for the business to understand. And the other one is predictability. Since there is no variability based on the type of card, businesses can easily predict their monthly processing cost. And what are the benefits of flat rate pricing? First, ease of use. Businesses don't need to worry about the complexities of interchange fees or varying rates based on card types. Another is the good for small businesses. For a low volume business, the simplicity of flat rate pricing can be appealing, especially for businesses just starting out. However, here are the drawbacks of flat rate pricing. It is potentially higher cost. Businesses with many debit card transactions or high transaction volumes may end up paying more than necessary because the flat rate is often higher than the interchange fees for debit cards. For instance, if the interchange rate for a debit card transaction is 0.8% plus $15 cent, the flat rate of 2.9% plus $30 cent is significantly higher. Example scenario. A small coffee shop processing $5,000 in credit card transactions per month might find flat rate pricing convenient. However, if most of these transactions are debit card payments with low interchange rates, The shop could be overpaying significantly under a flat rate model compared to a more variable pricing structure like the Interchange Plus. The next model is the Interchange Plus pricing model. In the Interchange Plus model, the processor charges the actual interchange fee for each transaction, plus a fixed markup. For example, if the interchange fee for a rewards credit card is 1.7% plus $10 cent, the processor might charge an additional 0.5% as a markup, bringing the total fee of 2.2% plus $10 cent. Here are the features of Interchange Plus statement. First is the transparency. The interchange fee and processor's markup are shown separately on the statement, giving the business a clear view of what they're paying. Another is the variable cost. Fees change based on the type of card, like debit, credit, or corporate, and transaction method like swipe or keyed in. And what are the benefits of interchange plus pricing? First is the cost savings. This model can lead to lower overall fees, especially for businesses that process a large number of low-cost transactions or that accept many debit cards. Another is transparency. Business owners can see exactly what they are being charged for each transaction, allowing for more detailed cost management. And the drawbacks of interchange plus pricing, the complexity. The breakdown of interchange fees and markup can be confusing, especially for business unfamiliar with credit card processing. Another is unpredictable cost. Since fees depend on the type of card and transaction method, it can be harder to predict exact monthly cost. For the example scenario, a high-end retail store processes a large volume of transactions with a mix of credit and debit cards. If this store uses interchange plus pricing, it may save money because it can take advantage of the lower interchange rates for debit cards. For instance, if the average interchange rate for debit cards is 0.8% plus $10 cent and the processor markup is 0.5%, the store would pay much lower fees for debit transactions than under a flat rate model. The next one is the tiered pricing model. In the tiered pricing model, transactions are categorized into different tiers based on the type of card used and the way the transaction is processed. Commonly, there are three tiers. Number one is the qualified, typically the lowest rate applied to standard debit cards and non-rewards credit cards. Number two is the mid-qualified, a higher rate applied to certain rewards cards or manually entered transactions. And number three is the non-qualified, the highest rate applied to corporate cards, international cards, or certain rewards cards. What are the features of tiered statements? Number one is tiers. Fees are grouped into different categories, which makes the statement appear simpler but less transparent. And number two, opaque pricing. Merchants don't see the actual interchange fees, so they can't tell which cards incur higher fees. What are the benefits of tiered pricing? Number one is appealing to some merchants. Businesses that primarily process qualified transactions might find this model attractive. And number two, simplified statement. Merchants see only three fee categories, which may seem easier to understand at first glance. And what are the drawbacks of tiered pricing? First is lack of transparency. Merchants cannot see the interchange fees and markups, making it difficult to understand what they are truly paying. Next is potential hidden cost. Many transactions may fall into the mid or non-qualified categories, leading to higher than expected fees. Here's an example scenario. A small retail store signs up for a processor that uses tiered pricing. The processor advertises a low qualified rate of 1.8%, But the store finds out later that many of its transactions are mid qualified or non qualified, like rewards cards keyed in transactions, resulting in actual fees closer to 3% on many transactions. The store ends up paying more than it expected. Let us now proceed to comparative analysis. Cost comparison across models. For the flat rate, simple but can be costly for businesses processing many debit cards or large volumes. Interchange Plus offers the most transparent and potential cost-effective solution but requires a more sophisticated understanding of processing fees. And tiered can lead to unpredictable and often higher fees, especially when many transactions are non-qualified. Transparency and ease of understanding. In the flat rate, it's easiest to understand as all transactions are changed or charged the same rate, but lacks transparency on what merchants are really paying for. In the interchange plus, the most transparent, showing exactly what interchange fees and processor markups are charged. And in tiered, appears simple but can be misleading, with hidden costs buried in higher tiers. In flexibility and scalability, flat rate best for small or low volume businesses. Interchange Plus better suited for businesses that grow and process a variety of transactions as it scales with the volume. Tiered may not scale well for businesses with a diverse customer base as more transactions will fall into higher tiers. Best use cases for each pricing model. For the flat rate best suit for small businesses or startups. Predictable costs make it ideal for new businesses or those with low transaction volumes. Example, a small bakery that processes $2,000 in transactions monthly would benefit from the predictability and simplicity of flat rate pricing. Number two is the interchange plus best suited for large, high volume businesses. Businesses that process a variety of transaction types and volumes benefit from the transparency and potential savings. Example, an online retailer with $50,000 in monthly credit card sales may save significantly under Interchange Plus because many transactions are debit cards with low interchange fees. Then in tiered pricing, best suited for businesses with consistent qualified transactions. Tiered pricing may work for businesses that predominantly process low-cost transactions with standard cards. Example, a gym that processes recurring payments with standard debit cards might find tiered pricing advantageous if all transactions fall into the qualified tier. Now here's the conclusion, the summary of key differences. In the flat rate, its simplicity, predictability, and potential cost concerns. In the simplicity, the flat rate model is straightforward, with a single fee applied to all transactions. This makes it easy for business owners to calculate cost without delving into the complexities of interchange fees. Its predictability. Businesses can easily forecast their monthly processing cost, which is particularly beneficial for budgeting and financial planning. Then potential cost concerns. While convenient, this model can lead to higher costs for businesses that predominantly cost or process debit cards or lower cost transactions. For example, if a business processes a significant number of low interchange debit transactions, the flat rate might not be the most economical option. Interchange Plus Transparency. This model allows businesses to see the actual interchange fees and processor markups, providing a clear understanding of what they are paying for each transaction. This transparency fosters trust and allows more for accurate cost analysis. And in the cost effectiveness, Interchange Plus can lead to significant savings for businesses with high transaction volumes or those that accept a mix of card types. For instance, a retail store with many debit card transactions could benefit from lower interchange fees under this model. Complexity. The breakdown of fees can be complicated, requiring business owners to invest time in understanding the structure. For those who are not familiar with the nuances of interchange rates, it may feel daunting. Tiered pricing, simplicity of structure. Tiered pricing offers a simplified overview by grouping transactions into qualified, mid-qualified, and non-qualified tiers. This can make it appear straightforward for some businesses. Hidden costs. However, this model often lacks transparency as merchants may not see the specific interchange rates associated with their transactions. As a result, businesses may end up paying more than they expected if many transactions fail into higher rates or higher tiers. Best for certain transaction types. Businesses that predominantly process qualified transactions may find this model advantageous, but those with diverse card acceptance might face unpredictability in cost. And for the recommendations, businesses should evaluate their transaction profiles considering factors like average ticket size, transaction volume, and card types to determine which pricing model aligns best with their needs. Regularly reviewing processing statements and staying informed about market trends can help business owners optimize their credit card processing strategies. Engaging in negotiations with payment processors and exploring various options can lead to significant savings and improved financial health for the business. By understanding these key differences and how they impact overall cost, business owners can make informed decisions that support their growth and profitability. Let us proceed to the practical considerations for businesses. Number one, evaluating your business needs. First is the transaction volume under evaluating your business needs. Businesses with high transaction volume might benefit more from Interchange Plus due to lower fees or on debit cards. For example, a restaurant that processes thousands of small transactions might find Interchange Plus advantageous. Then, average transaction size. Companies with larger ticket sizes might also prefer Interchange Plus, as the fixed fees could represent a smaller percentage of the total transaction amount. Then the card mix. Analyzing the types of cards used by customers can provide insights. If a significant number of transactions are through debit cards or non-reward credit cards, Interchange Plus could lead to lower overall costs. Number two is understanding fees in detail. Regular review of statements. Business owners should regularly review their credit card processing statements to understand their fees better. For example, if a business notices a high number of non qualified transactions, it may consider improving how transactions are processed, like encouraging swipe transactions over keyed entries. Then, calculating effective rates. Merchants should calculate their effective rates by dividing total processing fees by total sales to assess whether they are getting a competitive rate. Number three is scenario analysis for decision making. For the scenario one, a small e-commerce business. A small e-commerce store has monthly sales of $10,000 primarily from credit card transactions. Most of the cards are standard credit cards, not rewards. For the flat rate option, charges 2.9% plus $30 cent, leading to monthly fees of approximately $300. In the Interchange Plus option, if the average interchange fee for the cards used is 1.5% plus $0.10 cent, With a processor markup of 0.5%, the total would be about $260 monthly. For the decision, the business owner could save $40 monthly by opting to or for Interchange Plus. Scenario 2. A high volume retail store. A retail store processes $100,000 monthly with a mix of debit and credit cards. For the flat rate option, same 2.9% plus $30 cent, resulting in around $3,000 in fees. In the interchange plus option, with an average interchange fee of 1.5% for credit and 0.8% for debit, and a markup of 0.5%, total fees could drop to $1,800. And the decision, the retail store would save $1,200 per month by choosing Interchange Plus. Scenario 3. A gym with membership fees. A gym charges members a flat monthly fee of $50 with 1,000 members, leading to $50,000 in monthly credit card transactions, mostly through debit cards. In tiered pricing option, if most transactions are categorized as qualified, the gym may benefit from a 1.8% rate. However, if a portion falls into mid or non-qualified categories due to kid entries, the effective rate may rise significantly. Decision: this gym should carefully analyze transaction types and consider moving to Interchange Plus for better predictability and cost efficiency. Next is the negotiating terms with payment processors. Number one, understanding the market. Payment processing is a competitive industry. Businesses should research multiple processors and understand the standard rates for different models. Knowing competitor offerings can provide leverage when negotiating fees with processors. Example: a local coffee shop is currently using a payment processor charging a flat rate of 3.5% per transaction. After researching, the owner discovers that competitors in the area are offering rates around 2.9% for similar services. By presenting this information to their current processor, the coffee shop can leverage the competitive rates to negotiate a lower fee, citing industry standards and competitor offerings as justification for their request. Number two is requesting quotes. Businesses should solicit quotes from different processors, asking for detailed breakdown of fees, including interchange rates, markup percentages, and any potential hidden fees. Example: a small online retailer wants to switch payment processors. They reach out to three different providers to get quotes. Each processor provides a detailed breakdown. Processor A offered 2.9% plus $30 cent per transaction with a clear outline of interchange fees. Processor B offered 2.5% plus $15 cent per transaction, but with additional fees for chargebacks and non-qualified transactions. Processor C offered Interchange Plus with a base interchange rate of 1.5% and a markup of 0.5%. The retailer carefully compares those options and notices that Processor C offers the best potential savings for their high volume of debit card transactions, prompting them to initiate negotiations based on these quotes. Number three is evaluating contract terms. Review contract terms carefully. Look for length of the contract, early termination fees, conditions that might lead to increased rates like non-qualified transactions. Always aim for flexibility to change pricing models or processors if business needs change. Example: a gym owner reviews a proposed contract with a new payment processor. They pay close attention to length of contract. The contract is for 3 years. The owner wonders if they will still be satisfied with the service after that time. Early termination fees. The contract specifies a $500 fee for early termination, which is a deterrent if the gym needs to switch providers. Then the conditions for rate increases. The contract includes a clause that fees may increase if a significant number of transactions are classified as non-qualified. The owner decides to negotiate for a clause that allows for a review of rates after 6 months, ensuring flexibility. By understanding these terms, the gym owner can negotiate more favorable conditions, possibly reducing the early termination fee or adjusting the length of the contract. Number four is building a relationship with your processor. Establishing a good working relationship with the processor can lead to better service and potential discounts in the long run. Regularly communicate any changes in transaction patterns or business needs. Example, a medium-sized retail store has been using the same payment processor for several years. The owner makes it a point to communicate regularly with their account representative, discussing sales trends and any issues that arise. After a seasonal spike in sales, the owner informs the processor about the increased transaction volume and requests a review of their rates. Because they have built a strong relationship, the processor offers a temporary reduction in rates during the busy season, acknowledging the store's loyalty and potential for future growth. These examples illustrate practical steps businesses can take to negotiate effectively with payment processors, leading to better terms and potential cost savings. Here are the future trends in credit card processing. Number one is emerging technologies like mobile payments. The rise of mobile wallets like Apple Pay and Google Pay may influence processing fees and how transactions are categorized. The adoption of mobile wallets like Apple Pay, Google Pay, and Samsung Pay is rapidly increasing. These wallets enable consumers to make payments directly from their smartphones using technologies such as NFC or near field communication for contactless transactions. And for the impact of processing fees, as mobile payments gain traction, payment processors are likely to reevaluate their fee structures. For instance, transactions made through mobile wallets may have different interchange rates compared to additional card swipes. Processors may offer lower fees for mobile wallet transactions to encourage adoption, impacting overall costs for businesses. Example, a small retail store implements Apple Pay and notices a rise in customer transactions due to convenience. As a result, the store negotiates with its payment processor for lower fees on mobile wallet transactions, reflecting their growing importance in the marketplace. Cryptocurrency transactions. As more businesses accept cryptocurrencies, payment processors may need to adapt their pricing models. With increasing acceptance of cryptocurrencies like Bitcoin and Ethereum, businesses are beginning to offer these as payment options. Payment processors are adapting to this trend by developing systems that can handle cryptocurrency transactions. Adaptation of pricing model. Processors may introduce new pricing structures for cryptocurrencies transactions, potentially charging different fees based on the volatility of the currency or the transaction's complexity. This could lead to a tiered pricing model for cryptocurrency that resembles current card processing models. Example, an online retailer starts accepting Bitcoin and partners with a payment processor that charges a flat rate per transaction in addition to a small percentage based on the current market value of the cryptocurrency. The retailer must then analyze how these fees compare to traditional payment methods to ensure cost effectiveness. Number two is regulatory change. Stay informed about regulatory changes that could affect interchange fees or overall processing costs, such as changes from the Durbin Amendment or other financial regulations. Regulatory bodies frequently adjust policies that affect payment processing, including interchange fees. Staying informed about these changes is crucial for businesses looking to optimize their payment processing costs. For example, the Durbin Amendment, which limits interchange fees on debit card transactions for large banks, can significantly affect how processors structure their fees. Changes to this law could lead to fluctuations in costs for merchants. Other emerging regulations may focus on consumer protection, fraud prevention, or data security, potentially leading in increased compliance costs for processors, which could be passed on to merchants. Example, a restaurant owner reads about potential changes to the Durbin Amendment and proactively engages their processor to discuss how these changes might affect their fees. This foresight allows them to negotiate better terms before any increases occurs. And number three, consumer behavior shifts. The growing preference for contactless payment may lead to new pricing structures and potentially lower fees for these types of transactions. As consumer preferences evolve, so too do the payment processing trends. There's a noticeable shift towards contactless payments, largely driven by the convenience and safety they offer, especially in the wake of the COVID-19 pandemic. Payment processors may introduce pricing models that favor contactless payments, potentially offering lower fees for these transactions. This incentives merchants to adopt contactless payment technologies. As consumers increasingly prefer contactless options, businesses may find that offering these payments not only meets customer expectations but also enhances operational efficiency, reducing transaction times. Example, a grocery store chain decides to invest in contactless payment technology due to customer demand. In negotiations with their payment processor, they advocate for lower fees on contactless transactions, highlighting the increased volume of such sales. As a result, they secure a favorable rate, enhancing profitability. These trends in credit card processing highlight the importance of adaptability and awareness for businesses in managing payment systems. By staying informed about emerging technologies, regulatory changes, and shifts in consumer behavior, businesses can better position themselves to negotiate favorable terms, enhance customer satisfaction, and ultimately improve their bottom line. In summary, selecting the right credit card processing pricing model, either a flat rate, interchange plus, or tiered, requires careful consideration of business needs, transaction types, and cost implications. Here are the key takeaways. Flat rate offers simplicity and predictability but may not be cost effective for high volume or diverse transactions. Interchange Plus provides transparency and potential cost savings but requires more understanding and management. Tiered pricing may seem straightforward but can lead to higher, unpredictable costs if many transactions fall into higher tiers. And for the overall conclusion, ultimately, the best pricing model depends on the specific characteristics of a business, including transaction volume, average ticket size, and the types of cards accepted. For businesses with straightforward transaction patterns and low volumes, flat rate might be sufficient. For high volume merchants or those with diverse transactions, Interchange Plus is likely the most cost effective choice. For businesses seeking a balance but willing to navigate complexities, tiered pricing could work if they ensure most transactions qualify for the lowest tier. By carefully analyzing their processing needs and comparing the long term implication of each model, businesses can make informed decisions that enhance their financial performance and support sustainable growth. Regular reviews and open communication with payment processors will further empower them to optimize their payment strategies in an ever evolving marketplace. Merchants should also regularly review their processing needs, analyze transaction data, and remain proactive in negotiating terms with processors. Understanding these nuances can help businesses not only save money, but also optimize their payment processing strategies as they grow. Regularly reassessing the selected pricing model based on changing business conditions will ensure continued cost effectiveness. That is all for today, and thank you for listening. Have a nice day. Bye.